Good morning, everyone. Welcome to our 2023 Employer Rate Virtual Meeting. My name is Jeff Kemker, and I'm one of the assistant directors here at Loggers. And I'll let Melissa introduce herself as well.
All right, good morning, everyone. I'm Melissa Rackers. I am the Chief Financial Officer here at Loggers.
And what we're going to do today is we're going to give you a little bit of a preview of the 2023 employer contribution rates. We're going to talk a lot about how we determine what those contribution rates are, how and why they may change from year to year. And then Melissa's going to go through sort of how the money travels through the system, how we accept the contributions, bring those contributions into our system, invest those, and then ultimately pay those contributions back out to the benefit recipients. We would like for this to be as interactive as possible. So if there's any questions at all that you have throughout this, please use the chat feature or the Q&A on Zoom, and Melissa and I will see those as they come in, and we'll try to answer the questions as they come in. I would rather do it that way than wait till the end and then try to have a Q&A session and then we run out of time. So we want this to be information for you, information that you want to know rather than just listening to us talk about what we want to talk about. And so please let us know if you have any questions. Between Melissa and I, we should be able to answer any question that you have about Loggers, even if it's not something that is directly related to this presentation. We should be able to help you out with whatever you may have. So please utilize that chat feature and that Q&A feature as well. And before I get started, I just wanted to say that I'm very jealous of Melissa's background. She's very festive. It looks very cozy. And my background looks like I'm in a bunker somewhere. I'm not in a bunker somewhere. I'm in my office, but I have to congratulate Melissa on her excellent Christmas decorations. You're getting everyone in the Christmas spirit.
Well, I have to admit, my trees at home are in a partial state of decorated. We sort of ran out of steam and they're just kind of sitting there waiting for somebody in my household to decorate.
Well, your office decorating is on point for sure. All right, let's go ahead and get started. So one of the things that we always like to talk about at Loggers is that we believe we are more than just retirement benefits. Anything that you guys do as a local government entity ultimately must benefit the taxpayers and the citizens that you serve. And so we believe that the benefits that we offer, that the local governments in Missouri can choose, are a way for you to better serve your community by helping you to recruit the best people to serve the taxpayers, and maybe more importantly, keep those people during their most productive years, actually keep them in local government service. And then ultimately, the main purpose of a retirement plan is so people will eventually be able to retire. That's the whole purpose, is that people can work a career and then exit the workforce with dignity and able to have a standard of living in retirement where they are financially secure. And so we believe that everything we do at Loggers is ultimately trying to better the communities within Missouri. And with that, every decision that we make goes back to what our vision is. And our vision is a secure retirement for all. And obviously, we know at Loggers that this is something we're never going to be able to accomplish, no matter how long Loggers is in existence, which we assume is going to be forever. We're never going to be able to accomplish a secure retirement for every single person. And that's what we like so much about this vision, is that it's something that we're always striving toward. It's something that we can always look to, that we're always making one more little step towards that goal. And I know that every decision that we make here at Loggers, every maybe new initiative that we may be kicking around, we go back to our vision. Is it in pursuit of our vision? And then also, is it helping us to complete our mission, which is something completely different? Your vision and your mission should be different things, and ours definitely are. And we think about those very intentionally with everything that we do.
And we do try to, I'll just go back just a minute, Jeff, try to
Yeah.
kind of live those values every day. And one way to ensure that our staff is always keeping those values first and foremost is it's part of our performance evaluation on an annual basis. So part of our overall performance rating is partially determined by whether you're living those values every day as we serve our members.
Yes, absolutely. That's a way we kind of tie our values back rather than just something that's printed on a piece of paper or hanging on our wall to each individual person. So it is something very, very important. Okay, jumping into some updates here. Loggers is a growing public pension plan. And this is something we're going to talk about several things today that are unique to the Loggers pension plan compared to other pension plans. And this is one of them. The fact that we are constantly adding new employers to the system. Many public pension plans in the country, they have their membership and their membership is what it is. It's not growing. The only thing that's growing would be the retired population, but the number of employers and even the number of active members pretty much stays level. Loggers is not that way. Every month, we are adding at least one new employer to our system. And you can see here over the last 10 years, the growth that we've experienced in the number of local governments in Missouri that we're serving, from 644 up to 831. So we are a constantly growing system. Most of these employers, about 70%, are switching from a 401k type retirement plan, more of an account balance type plan, to Loggers defined benefit model. So I think that is that just constantly gives us a sign that these benefits are something that the local governments are valuing, the local government employees are valuing, and that the defined benefit model is still the preferred model for local government entities. Now, within that, you can see the number of employers, but you also see this other white line we have here that we call valuation groups. What this means is that we have all of our 831 employers that are within this umbrella of the Loggers system. But within each employer, they may have multiple departments within Loggers, meaning they have multiple contribution rates. So for those of you listening that maybe you work for a city, you could have 3 or 4 different contribution rates just at your city between your general department, your police department, your fire department, and now we have this new public safety department that's available as well. So that's the number of valuation groups that we have, meaning the number of contribution rates that our actuary has to come up with every year. So we have 830 employers. They all have different contribution rates. And then within them, they may have 3 or 4 different contribution rates within each employer. So every time we add a new employer, it just adds to the complexity of the system and what we do, because each employer is its own separate little unit within Loggers. And we're gonna use this term multiple times today, so I'll just introduce it now. And Loggers is what we call an agent multiple employer plan, meaning that each individual employer is its own unit and it pays its own cost and it chooses its own benefits. And that is something that's very, very unique within the public pension plan community if you look at pension plans all across the United States. So this is just a snapshot of who we serve as far as our membership. As far as the employers are concerned, obviously it's no surprise that the biggest chunk of our membership are cities, 40%, but you can see that we represent all facets of local government between soil and water conservation districts, fire districts, health agencies, counties, emergency services. Any local government entity that is defined as a political subdivision within the state of Missouri with the authority to tax is allowed to join the Loggers system. Now, most of our presentation today is going to be focused on the money coming into the system. And unfortunately, that's usually where the focus is when you talk about local government employee benefits. Well, how much do they cost? How much money are we paying in? But something we always like to remind as many people as we can talk to is what about the money coming out of the system, the money that's being paid back to the benefit recipients? And that's a very, very important number to focus on as well. And at Loggers, we like to talk about this. We can break this down to the county level, to city level, to legislative district level to show how much money is being paid back. Because anything, again, anything that you guys do at the local government level has to ultimately benefit the taxpayers. And so what is the return on the investment that the taxpayers are getting for helping fund these pension benefits for the public servants? Well, one, they're getting the service of the folks while they are working, and hopefully this benefit is helping retain those people so they stay longer and provide those services to the community. And then when they retire, about 95% of those people remain living in the communities they serve. So their pension checks are being spent right back into the communities. I've spoken with hundreds of retirees over my career here at Loggers, and I always like to ask, how many of you, when you get your ACH payment, your direct deposit payment from Loggers every month, how many of you cash that out and go stuff it in a jar and bury it in your backyard or stuff it under your mattress? And nobody ever says that they do that, because they need that money. They rely on that income, and they're using that money to support their lifestyle, spending it mostly within their local communities, and that is helping put that money back into the system. So out of $403 million that Loggers paid out in benefits last year, 384 million of that stayed within the state of Missouri. Those are really big numbers. And if you think about $384 million getting paid back within the state of Missouri every year, that number goes up every year because we're adding more retirees. The retirees are getting cost of living adjustments, and so the benefits go up each and every year. Okay, let's talk a little bit about our funding. So this is just a snapshot of the asset growth of the Loggers Pension Fund over the last year, approximately October to October. It hasn't changed much since October, so it's been relatively flat. We started the year, if you look back 12 months, around $10.1 billion in assets. We're at about $10.1 billion today. We get a weekly report from our investment team, and I looked at that yesterday, and we were again at $10.1 billion. So it's been relatively flat over the last 12 months, which is actually not a bad thing, considering what the markets have done over the last year. I know, I'm sure any of you that have any money invested in the markets at all have looked at your account balances and wishing that they were flat for the past year. I know mine certainly have not been flat. And so the fact that our investment team has been able to make really good decisions in how that money is invested and keep those assets at least level, doing the best they can to protect the assets that we have in this market environment, I think has been a pretty good thing. So that's where we're at with the assets that we have under management. Now, what we have been able to do over the last year is continue to pay down the unfunded liability of the Loggers plan. So when we talk about the unfunded liability, what does that exactly mean? Well, with a pension plan, you have liabilities and then you have assets. And liabilities are basically the dollar amount cost of how much the benefits are worth for all of our members. How much are their benefits actually worth? What's that dollar amount that they cost? And that's the number we're trying to pay for. That's the number we're trying to pay off. So then you have assets, and the assets of the system is the money that we just looked at, the $10.1 billion. It's made up of contributions that are coming in from employers and employees, and also the investment return of the system. Okay, so you have assets and liabilities. Now we're trying to pay off the liabilities. So the amount that we haven't paid off yet the difference between the assets and the liabilities, that's where you get your unfunded liability. This is the amount that we still need to pay off in order to be fully funded. And Logger's goal is to be fully funded. So one of the goals of our funding policy is to make steady progress in paying down the unfunded liability. And you can see we've done that over the last 10 years. We've reduced that from $731 million to $349 million. So we're making steady progress on that, on paying for that unfunded liability. And because Loggers is an agent multiple employer plan, each one of you also have liabilities, assets. You may have an unfunded liability that you're still working on paying off. And we have different amortization periods that are going on with your employer. But Logger's total unfunded liability that we're looking at here is just the sum of all of our employers' unfunded liabilities added together. So that's what we're looking at here. We want our employers to be making steady progress on paying off their unfunded liability as part of our funding policy. And you can see that as a system as a whole, we are making progress on that. Now, our funded ratio, this is the most common measure that's used to look at the financial health of a pension plan, the funding ratio. Now, we just talked about the difference between your assets and your liabilities. If you subtract those two, you get your unfunded liability, right? Well, to determine your funded ratio, what you're doing is you still have those two measures. You're just dividing your assets by your liabilities to come up with your funded ratio. Now, again, Logger's goal is to be 100% funded. So not all pension plans have that goal. Some pension plans, their goal is to be 80% funded or 90% funded. And there's different reasons for that. But as far as Loggers is concerned, our goal is to be 100% funded and just to be making steady progress towards that goal. You can see again, even though our assets were relatively flat over the last year, our funded ratio did increase. And so we're continuing to just make steady progress toward that goal of reaching 100% funding.
Jeff, we did have a question
Yep.
asking how do they know if they have an unfunded liability? And this can be found in your annual actuarial valuation.
Yes, so the annual valuation, we send you every year in July. You get that either the last week in June or the first week in July. We are required by law to notify you of your contribution rate at least 6 months before it takes effect. So if you have a January 1 fiscal year start, that means we have to tell you by July 1. So we send everyone's annual valuations to them in July. So no matter when your fiscal year start is, you're getting it in July. Now, we don't send them to you anymore. We used to print them off, mail them. Everybody got 2 copies. That was a huge expense to the system. So now what we do is we post them on Eclipse. We let you know when they're there, and you can go and look at the PDF whenever you want to. Your unfunded liability can be found on a couple different pages in that report, but the easiest place to find it is pages 12 through 15, I believe.
I think so, yeah.
Yeah, if you have multiple departments, it'll be like page 12, 13, 14, and you can see your unfunded liability for each department. And some of you, as you can see by this slide here, some of you may not have an unfunded liability. You're 100% funded or over 100% funded. As you can see in this slide, the biggest chunk of our employers are 100% funded or better, which is fantastic. So each employer has their own funding level. They have their own assets, liabilities, and that's shown in your annual report each year. So you can see your funded percentage. You can see even the amortization periods. So you can see how much longer you have until that unfunded liability is fully paid for, which is helpful because you can look to that and know that, okay, once this amortization period drops off, I can expect a decrease in my contribution rate because of that. If you guys ever get into that report and have questions about it, just call us, call me or Mel, and we can help you with that. Just kind of explain what the numbers mean and how they work and how that affects your employer individually.
And if you're actually logging into Eclipse, during this webinar, if you're having trouble finding it, it's under the agency details, and then you have a list of tabs across your screen, and there is an actuarial tab, which will have all of your annual valuations, any supplementals that you've requested, as well as your initial.
Yep. And those go back about 10 years. So
yes.
So you can see back to about 10 years worth of your annual valuations and how, things have changed and that sort of thing. So again, each employer is its own individual unit. So you have your own contribution rate. Your contribution rate, we'll go into this in more detail later, but it's based on the benefits that your employer has chosen and the demographics of your group are the primary things that drive your employer's cost. So contribution rates can range, as you can see from this slide, all over the place. But we tried to break this down for you because we always get asked, especially by local governments thinking about joining the logger system, well, what's the average contribution rate, or about how much can I expect this to cost, which is really hard to answer when you don't know anything about the demographics of their group. But we can generally tell them, well, the contribution rates generally fall in this range. As you can see here, the biggest chunk of those fall between the 4% and 16% of payroll range, which again is a pretty big range, but that's the best we can do sometimes when we're just ballparking.
But again, like Jeff said, because we're an agent multiple plan and everyone has an individual employer contribution rate, it's hard to just throw out a number and say, yeah, this is where we think you'll be.
Right. Right. So you can see on the right-hand side of this graph, very few of our employers are paying more than 25% of payroll for their benefits. And I would add to that if they are paying more than 25% of payroll, there's usually a very specific reason why that is happening within that specific employer. All right, for 2023, I'm sure many of you have already looked at your contribution rates. You already know what those are going to be, especially if you have a January 1 fiscal year start. But this is kind of the breakdown of what they're looking like. One of the goals of Loggers funding policy is contribution rate stability. It's one of the things that we're trying to accomplish. So you guys can have a little bit easier time budgeting, know what to expect. So over the long term, we want your contribution rates to remain relatively level. And I think this chart is one of those that demonstrates that. It's because it's about 50-50 as far as how many rates are decreasing during the year and how many rates are increasing. So you can see that a little over half of the contribution rates for 2023 are either going down or they're remaining the same. One of the big reasons for the increases, so for those employers that are having contribution rate increases for 2023, is because of our employers having to respond to this tough workforce environment we've been in for the last couple of years. And they've had to increase their salaries that they're paying to their employees more than we expected them to. And so we'll talk more about this later, but when that happens, when you increase your salaries by more than we expect, that means that the pension is going to cost more, because now you've not only increased those employees' salaries, you've increased their pensions as well, because a component of Loggers' pension benefit is based on salary. So the higher the salaries, the more that benefit's going to be. And so you increase the pension or the salary, that also increases the pension benefit. That's one of the big reasons for that. Okay. Again, I think this is another way to demonstrate our commitment to contribution rate stability. What this is showing is the total contributions, employer contributions that have been paid into Loggers over the last 10 years as a percent of the total payroll of all of our members. You can see it's remained relatively flat over the last 10 years, the total amount of contributions we're taking in as a percentage of payroll. Now, the dollar amounts that are coming into the system are increasing a little bit each year because we're adding new employers, salaries are going up. So the dollar amounts may be actually going up, but as a percentage of the total payroll is also increasing. So the percentage of that payroll is remaining relatively level, which is what we like to see. So when we calculate your contribution rate, again, your employer is paying for the benefits earned by the employees when they're employed at your employer. So we're an agent multiple employer plan. The other side of that coin is called a cost sharing plan. So I'm sure everybody knows a teacher, and the teacher's pension plan in Missouri is the largest public pension plan in the state by far. And they are a cost sharing plan. So what that means is that every teacher pays the same amount out of their paycheck. They pay 14.5% out of their paycheck. They don't get Social Security, so they pay more. And then the school district matches that. The school district also pays 14.5% to fund the benefits. Every teacher gets the same benefits, that they're calculated the same way. It's not different from one school district to another. They all have the same benefits, all pay the same amount. That's called a cost sharing plan. So at Loggers, we've been talking about, it doesn't work that way, but there are two components of the Logger system that are cost sharing. And we do this to help reduce the risk to you guys, the employer. In a defined benefit pension plan, as you know, the employer is taking on more of the risk than the employees are taking on. You're taking on namely the investment risk, but also some of the risk of the experience that could happen. And so again, as part of our goal of maintaining contribution rate stability, we have a couple things within the Logger system that actually are cost sharing. One of those is our benefit reserve fund. What the benefit reserve fund is, it's a separate pool within the Loggers overall $10.1 billion. It's a separate fund, and Melissa's going to talk more about this later, and as far as how much money is in that fund and that sort of thing. But the benefit reserve fund is the fund we pay all benefits out of. So all the monthly benefits are paid out of the benefit reserve fund that go to the benefit recipients. When someone retires from your employer, literally what we're doing at Loggers is we're calculating basically a present value dollar amount. How much, if we have to pay this person for the rest of their life, how many dollars do we need today to set aside in order to pay that person for the rest of their life? So let's say we do that calculation and it comes out to $200,000. Well, what we do is we take $200,000 from your employer's assets within the Logger system, and we transfer that over to the benefit reserve fund. Once we do that, that person's benefit is fully funded. Okay. It's a one-time transfer. So if that person lives longer than we think and we pay out more than $200,000, we don't then come back to you and say, hey, Bill's still alive, we need more money, and we do another transfer. It's a one-time transfer. But the opposite is also true. If your employee doesn't live as long as we expect and we pay out less than $200,000, we don't then credit that back to you as the employer. It stays within the pool, so it's available to all the retirees. And that helps to ensure that those benefits will be able to be paid every month for the rest of their life for everybody that's receiving benefits from that pool.
So it's protecting the employer from the mortality risk. It's also protecting the employer from the risk of cost of living adjustments being more than we are going to estimate. But it also protects the retiree too, because we can really only use the funds in that reserve account to pay retirees and beneficiaries.
That's right. So the other cost sharing pool that we have is the casualty reserve fund. And what this fund does is it pays benefits for disabilities within the system and duty-related death benefits. And so a small portion of your contribution rate every month goes into this casualty reserve fund. Every employer that has a certain benefit program, so let's say you have the L7 benefit program, all the employers with the L7 pay the same rate into the casualty reserve fund, same percentage of payroll. Okay, so that's a cost sharing tool. And the reason we do that is because our actuaries are pretty good at predicting when someone's going to retire. They're really bad at predicting when someone's going to become permanently disabled or when they're going to pass away before they retire. So we pay the benefits, we have you pay the same amount, we share that risk across all of the employers so that if you do have that unexpected event and now all of a sudden you're paying benefits to someone that's maybe in their 20s or 30s or 40s unexpectedly, that could really ramp up your contribution rate for maybe decades to try to make up for that actuarial loss. So that's why we pay the majority of the funds out of the casualty reserve fund. Now, we still are going to transfer some out of your assets. And what we're going to transfer out of your assets are basically how much that person has already accrued. So whatever their current benefit amount is, that's what we're going to transfer from your assets. But anything above and beyond that, if it's a duty related disability or death, we're extending service credit until that person is age 60. So that portion is going to be paid out of the casualty reserve fund. That helps protect your contribution rates as well. So those are the two cost sharing elements we have within loggers, with everything else being basically specific to your employer.
Real quick, Jeff, just so they know, just another component of that, of your employer contribution rate is based on whether your employees are general, police, or fire. So you're going to pay a different rate for police employees and fire employees than you do general, just because based on past history, we have seen that those two groups have a little bit higher experience with duty-related disabilities than a general employee.
Yep, good point. So another thing that the actuaries use to determine what the contribution rates are what we call actuarial assumptions. And basically what these are is if we're trying to pay for a future retirement benefit that's going to be a monthly lifetime protected benefit, we have to make assumptions about things that are going to happen in the future. Okay. And those assumptions, there's two types. There's demographic and economic assumptions, and we'll look at those on the next slide. But they help us make predictions about the future so we can properly fund the benefits. And we review these once every 5 years. The next review is going to take place in 2025. And when that happens, our board can, if they want to, and if the actuary is recommending them, make small tweaks to those assumptions. That can happen. And when that happens, that can have an impact on your contribution rate because the assumptions will impact your contribution rate when we change them. Now, I will say that, there's a lot of talk about, well, are these the proper assumptions you should be using? Especially the investment return assumption is the one that gets the most attention. Should you really be assuming a 7% annual return? Maybe it should be lower. Well, I would argue that because we're adjusting your contribution rates every single year, you're not paying for our assumptions. You're paying for the experience because we're adjusting your contribution rate every year. Now, I could maybe buy that argument if you're not adjusting the contribution rate every year, if you're adjusting it every other year or every 5 years, or you have to go through the state legislature to change your contribution rate. But since we're adjusting your contribution rate every year, you truly are paying for the experience because we are taking that experience into account every single year and making small tweaks to your contribution rate to fulfill any changes between the assumptions and the experience. So some of the demographic assumptions that the actuaries look at when they calculate your contribution rate are how many members are leaving employment within that 1 year period, how many disabilities are you going to have, obviously how many retirements, salary increases, we've already talked about that. And then obviously, Melissa mentioned this, mortality. How long are people going to live, both before they enter retirement and then after they enter retirement? So the most important actuarial assumption of them all is the assumed rate of investment return. So in order to project out how much the benefits, how much we need to bring in as far as contribution rates are concerned, we have to make an assumption about how much return we're going to get on the investments. All the contributions that we take in from our members and employers are pooled together and invested in the markets. Now, we assume we're going to get a 7% return every single year. And we did reduce that the last time we looked at these actuarial assumptions from 7.25 to 7. So that's the assumption that we use. Now, year to year, if we get a higher than 7% return, the excess up and above that is credited back to the employers. Okay. If we don't get a 7% return, like we didn't get this year, then the employers might have to pay in a little bit more to make up for that. Okay. So that is the most important assumption because it drives a lot of the costs for what the contributions need to be. But we also look at price inflation, wage inflation. So wage inflation and payroll growth are 2.75% annually. Again, we talked about this. Some of the contribution rate increases we're having for 2023 are because many of our employers increased their wages by more than 2.75% this last year. So that is, bumping up their contribution rates because of that. So that's a quick look at our assumptions.
I would say your payroll growth is also a pretty major assumption. So not just looking at individual salary increases, but also looking at overall from your agency, what's happening with your payroll. I mean, do you have a lot of vacancies that you haven't been able to fill? So maybe over the past year, your payroll was actually lower because those positions were vacant. So we may have needed to increase your employer contribution rate to make up for the lack of dollars that didn't come into the system because your payroll was lower than we might have assumed.
Right. The actual dollars coming into the system are, maybe about the same, but it looks like you're paying more because your contribution rate went up. Yeah. Okay. I think I've already pretty much mentioned everything on this slide. So when it comes time for our actuaries to do your annual actuarial valuation, they're putting all this data into their system, the assumptions, the local demographic data at your employer, the asset data, and then they're coming up with the annual actuarial valuation that you get, like I said, the beginning of July every year, as well as your next year's contribution rate. So we always match your contribution rate changes up with your fiscal year start. So I believe we have at least one employer that has a fiscal year start every single month out of the year.
We do, yes.
So there a lot of you have July 1st fiscal year starts. So that means you're getting your contribution rates a year in advance. Some of you have October or November or even December fiscal year starts. And so you're getting your contribution rates 14, 15, 16 months in advance every year. So whenever you get that email from us, your annual actuarial evaluation is available first week in July. You can start your budget planning for the next fiscal year because you already know what your contribution rate will be. All right, at this point, I'm going to turn it over to Melissa to talk about loggers, investments, and other things.
Okay. Are you going to advance the slides, Jeff, or am I going to be it?
Yeah.
Okay.
Yeah,
Go ahead. All right, there we go. So as Jeff mentioned, we on an annual basis are assuming a 7% investment return. We obviously know that realistically, we are not going to earn 7% each and every year, but really the goal is over the long term, are we reaching that goal? So our 1-year return as of June 30, 2022, obviously we did not. But if you look at our 3, 5, 10, 15, and 20, we still are exceeding that 7% assumed rate of return. And just a little background on kind of where that number comes about. The first piece that our investment team will talk to our board about is how much risk as a system are we willing to take on with the trust fund dollars. As employers and as members, you want us to take on a reasonable level of risk because of the risk and return of investments. If we didn't take on any risk, obviously our investment returns would be considerably lower than what they have been. And if investment returns are lower, then as Jeff mentioned, the employers have to start kicking in more. So the first piece of the conversation is always how much risk are we willing to take on? What is that standard deviation? And then from that, we look at liquidity risk, inflation risk, where we want to be in relationship to those, and start looking at different pools of investments that are available to us, and figuring out, where we want to be in equities, where we want to be in fixed income and real estate, and determine what sort of our target allocation is. And then we give that information to our actuaries, and they put that in their fancy systems and look at capital market assumptions and spit out sort of a range of where we think we could be with our investment return assumption. So that's where that 7% actually comes from. We don't kind of just pull 7% out of a hat and decide, okay, that sounds like a good goal. Now, how do we get there? The first part of the conversation is always about risk and how much risk we're willing to take on. All right, you want to go to the next slide, Jeff? So this chart is just showing our actual returns over the last 10 years in relationship to our assumed rate of return. Like I said, we assume 7, but obviously we know year to year we're not actually going to earn exactly 7. If we do, you should actually probably be questioning that. So if you want to go to the next slide. So the previous slide was actual returns as of June. This slide is actually prepared by our actuaries every year because this is our actuarial value. So what Loggers is doing for an actuarial basis is we are smoothing investment returns over a 5-year period. So we're trying to take some of those spikes out of the experience in relationship to the assets used to calculate your employer contribution rates. So the blue line is the market value, but the orange line is the actuarial value, which you can see is working to take some of those kind of peaks out. Because as Jeff mentioned, one of the goals of our funding policy is to have level employer contribution rates. And like I said, we know we're not going to earn 7% every year. So we are going to smooth out any differences plus or minus of what we would have earned at 7% over a 5-year period. Just to kind of give you just some numbers. Right now, Loggers is kind of held back $885 million because our market value actually exceeds our actuarial value. So over the next 4 years, we'll roll that $885 million into our actuarial value of assets that we're going to use to calculate your employer contribution rate. So as Jeff mentioned, over the last year, returns have been relatively flat. So as of February, the end of February, we're probably not going to earn our 7%, but we do have $206 million sort of, in reserve to kind of pad that loss that we'll have because we won't likely earn the 7% as of next January. We can go to the next slide. So just going to touch just real quick on some of the benefit options that Loggers has. As Jeff and I both mentioned, we're an agent multiple plan, meaning that each individual political subdivision is going to pick the benefits Loggers has to offer for what they want to actually offer their employees. So some of these benefits are the final average salary. You have the choice of a 3-year or a 5-year final average salary. Generally, the 3-year is a little bit more expensive because averaging it over 3 instead of 5, you generally have a little bit higher ending salary. The benefit multiplier, wide range of benefit multipliers to pick from, anywhere from 1% to 2%, maybe a little bit higher if you don't participate in Social Security. We also have some temporary benefits. So again, that is an option that each individual employer is going to choose for their employees. From a retirement eligibility standpoint, normal retirement for a general employee is age 60. It's 55 for police, fire, public safety, if you've elected that option for your public safety employees. But there is also the option for a rule of 80. So meaning if your age and your years of service add up to 80, you're eligible to retire under normal retirement benefits. From an employee contribution standpoint, you can elect to either have your employees contribute or not contribute. If you choose for your employees to contribute, then your options are 2%, 4%, or 6%. And you can change these individual elections once every 2 years. This is just two charts we wanted to share with the group, just to kind of show over the last 10 years how much our membership has increased the benefit multipliers. The L6 is our 2% multiplier, and you can see from over the last 10 years that group has grown from 34% to 48%. Average multiplier has increased from 1.65% to 1.7%. Or 1.76%. And this is interesting if you think back at how much we're paying down our liabilities. So as employers elect higher benefit multipliers, that increases your liability. So even with employers increasing liabilities or requesting upgrades from the system, we are still making progress on paying down our unfunded liability. This is our pension funding formula. So the goal of a public pension system is to collect enough contributions and investment earnings to pay the benefits and expenses of the system. So that is why we are looking at employer contributions on an annual basis to make sure that we are only asking of our employers to make that contribution that's needed, plus investment returns, solely to pay the benefits and expenses. As we mentioned with the benefit reserve fund, that those funds can only be used for the exclusive benefit of our retirees and beneficiaries. And as a public pension system, we can only incur administrative expenses needed to administer the plan, meaning that we can't just go out and do what we want with that $10 million. It solely has to be for the benefit of our retirees and beneficiaries. And I don't know if I have specifically mentioned this, but Loggers really only has 3 funding sources: investment returns, employer contributions, and employee contributions. So on average, over the last 5 years, 70 cents of every dollar has come from investment returns. Again, that is why our 7% assumed rate of return is highly important, why the system is willing to take on a reasonable level of risk to try to make as much money on investment returns as we can so that we're not having to ask the employers and members for as much. So 27 cents has come from the employers and 3 cents has come from the employees. We have a pretty large portion of our membership that does not contribute to the system. So we've talked a lot about the investments and about the funding. As we mentioned, from an investment standpoint, all $10 billion is in one pool, and we're allocating that to our individual investment managers. But kind of from an accounting standpoint, we are maintaining separate funds or reserve accounts. So one of those reserve accounts is the employer fund. So as of June 30, it was about $4.5 billion. And we truly do track that within our Eclipse system by individual employer, and within that employer by your individual valuation group. So whether you have general employees, police employees, or fire employees. The next fund, oh, Jeff, you want to go back? Sorry,
jumped the gun.
The next fund is our employee fund or our member fund. So this is the actual contributions made by each individual employee if the employer has elected for them to contribute. And again, we keep track of that by each individual person. And then those bottom two again, are our two pooled funds, the Benefit Reserve Fund and the Casualty Reserve Fund. Those two funds, while we have the data by individual employer or by individual employee, it's really not meaningful. We really don't use it except for to help us make allocations for GASB purposes, because those two, like we said, are pooled funds. All right, now we can go. So this is just a quick snapshot of where we were at from a revenue standpoint as of June 30th of 2022. Again, our only sources of revenue are contributions and investment income. So revenues totaling about $316 million as of June 30. And then next we have our expenditures for the year. Again, our expenses for the year are benefit payments, refunds elected by individuals who have left employment during the year, administrative expenses. So the cost of actually running the logger system are, salaries and benefits, as far as the employees of loggers, the consultants that we use, the cost of having a building and equipment. So all those administrative expenses that are necessary to actually run the system. And then the pension expense and OPEB expense, those of you who get involved in your GASB reporting, because Loggers is an employee and we do offer a pension and OPEB plan to our employees, we also have to report our GASB 68 and GASB 75 expenses. So one thing I will note, Loggers is cash flow negative as a system. We have been for about 10 years. We're slightly negative. We need about 1% of our funds for cash every year to pay retirement benefits. So it's pretty minimal, but that's also how the system was designed. When the system was created back in the late 60s, the actuaries knew that we would reach a point where our retiree growth exceeded our active member growth. So they were collecting more from the employers than they actually needed so that we could build up this pool of money and then invest those funds and increase our investment returns. When we reach that point, our retiree growth exceeds our active member growth. And we've been there, like I said, for about 10 years, but that's nothing to be alarmed about because it was very intentional. That is how the system was designed. We aren't like Social Security, where what we as individuals are paying into Social Security today is being used to pay the current retirees receiving Social Security. It was very intentional that we built up this pool of assets so we had the money set aside to pay future retirees. So again, the fact that we are cash flow negative is very intentional, so it shouldn't be anything that anyone is concerned about. So mechanically, what happens with the funds, once our employers log into the Eclipse system, they complete their statement of account, reporting all the wages for their employees, and then the Eclipse system calculates the amount that's due loggers. And you guys initiate your ACH payments, we receive the funds. So this is what the Eclipse system is actually doing with the funds once we receive the payment. We're splitting that employer contribution rate for the members if your employees are contributory. And then the actual employer portion gets split between your employer fund and that casualty reserve fund. As we mentioned earlier, a portion of your employer contribution rate based on your benefit multiplier and your valuation group goes into that casualty reserve fund. And all these funds remain here until a payment is required. So if someone terminates employment and they request a refund of their contributions, we'll pay that directly out of the member deposit fund. But once someone actually retires, and Jeff touched on this earlier, we'll do that present value benefit calculation. So making an estimate of how many payments will pay that individual retiree based on their age, based on their sex, because of the mortality tables. How many payments do we actually think will pay that individual? We also make some assumptions for cost of living adjustments, and then discount that into today's dollars and make that one-time transfer from the member deposit fund if they're contributory. Then most of it comes from the employer accumulation fund, and then a portion would come from the casualty reserve fund only in the instance that is a disability retirement. So then those dollars remain in that benefit reserve fund solely for the benefit to pay our retirees and beneficiaries. So we talked a lot about the funded status of the system and that each individual employer has their own funded status. Something that the actuaries do along with what we call our consolidated report. So when they look at the system as a whole, they do look at the funding level of these 4 individual pooled funds. The employee fund and the casualty reserve fund are both considered 100% funded because they really don't have their own individual liabilities. They are created to assist the employer in paying for the retirement benefits. So they are considered 100% funded. With that said, with the casualty reserve fund, it is something that we look at every 5 years with our experience study to see what the asset level is of the casualty reserve fund to make sure it is growing. Because if it's not, then there is the fear that depending on our experience with disabilities, we won't continue to have those funds available. So that is when the actuaries would recommend changes to the board to that employer contribution rate that is used to fund that casualty reserve fund. So while we do consider it 100% funded, it is monitored with our experience study to make sure that we're maintaining an adequate level of assets to fund those disability retirements should they occur. The employer fund is considered 92% funded. So of all of our liabilities that we currently have accrued for active workers, we have 92% of those assets set aside to pay those current benefits that have been earned. And then the benefit reserve fund is 119% funded. So we said overall our goal is for our employers to be 100% funded. The loggers board and staff and actuaries are okay with this benefit reserve fund being a little bit over 100% funded. Again, this is just an extra level of protection for our retirees and beneficiaries. In our current environment, it's actually very beneficial that for our retirees and beneficiaries that we're a little bit more than 100% funded because with inflation, the past 2 years being over 4%, we owe our retirees some cost of living adjustments. So just a little bit of background of how loggers COLA works is it's CPI based, but we are capped at 4% annually. So anytime CPI exceeds 4%, we have to catch up those employees in future years once the CPI goes below 4%. But when we actually look at that reserve calculation that we're doing at retirement, we're only assuming 2%. So we'll be paying out, we have the last 2 years and we will in future years, higher than that 2% assumption that we've been making. So having those excess funds and that benefit reserve fund will help protect our retiree COLA. So then that doesn't put the board in a situation where they have to consider whether or not they're going to give our retirees a cost of living adjustment. We won't let that benefit reserve fund get too overfunded. If it reaches 125%, we will make some adjustments with our interest crediting process and not give as much interest to the benefit reserve fund, and we'll give more to the employers. On the flip side, if it falls below 85%, then we'll give more of the investment earnings to the benefit reserve fund and less to the employers. Okay, now we're ready. So 2 of the major processes that we do as part of our annual reporting and the end of our fiscal year is we actually take all those investment earnings or losses for the year and allocate them to these 4 funds. So the first fund to receive an allocation is always the employee fund or the member fund. The board determines the interest credit percentage that is going to be allocated to the members. This year it was 0.5%. It's been 0.5%, I believe, since 2010. But again, that is something that the board looks at on an annual basis. The mindset behind that is they sort of look at it as a passbook savings because these member contributions are not similar to a 457 plan. This is not about an employee building wealth. This is an employee assisting the employer in paying for this defined benefit. So again, this is not a defined contribution account where the employee is trying to build their assets. It really just assists the employer with paying for the defined benefit. So the board had set that interest allocation amount at 0.5%. The casualty fund, the disability fund, receives their sort of money second. And the board again sets that allocation percentage. And generally the board sets the assumed rate of return. So the casualty reserve fund received 7%. And then whatever is left of the investment earnings gets credited back to the employer and the benefit reserve fund. The employer allocation is based on your weighted average asset balance. So each employer is getting a percentage of our investment returns based on their asset balance. And if you want to see what that dollar amount was for the year, you can see that in your GASB 68 reporting on that investment earnings line. And I know we have a percentage of the fund there, and it looks like the employer fund didn't receive anything because it didn't round at over 0%, but just from a dollar perspective for the year. So of our $7+ million in investment earnings, the benefit reserve fund received about 3.4 million. The employers in total received 2.2 million. The member accounts or the employee accounts received 792,000. And then the casualty fund received 1.8 million for the year. Another annual process that we do that we don't have a slide on is allocating the administrative expenses. So in previous slides, we saw that our administrative expenses for the year were a little over 8 million. So we do allocate that $8 million between the employer fund and the benefit fund. We split it between those two, and we do that based on headcount. So the benefit reserve fund receives an allocation based on the retiree headcount, and then the employers receive an allocation based on your active members and your deferred members. And again, that amount of the administrative expenses that was allocated to your individual employer is available in your GASB reporting. Okay. So some of the documentation that we received, we've talked about the actuarial evaluation several times during this presentation. Again, you receive it by July 1st of every year. And then we also send you a rate notice letter 2 months prior to your rate change. Because as Jeff mentioned, some of you actually receive your valuation quite a bit early, up to 16 months sometimes before your actual employer contribution rate will take effect. So we do send a letter to you just as a reminder. And if you don't look at your actuarial evaluation, I would definitely encourage you to do so. Again, it's available on Eclipse. There's a lot of very valuable information in that document. One of the questions that came through was, how do I know what benefits the employer has elected? Well, that also is in your actuarial evaluation. And working with your auditors and with those of you who are responsible for your GASB 68 reporting, a lot of times if you're looking at your deferred inflows and outflows, the only way to get the answers to what's happening there is to look at your actuarial evaluation, because it's not in your GASB reporting. It's knowing what happened to your salary, what's happening with your average service. Those types of things are part of your difference between assumptions and what actually happened that flows into your GASB reporting for your deferred inflows and outflows. So you often have to kind of dig through that actuarial evaluation to get a feel of what's going on with your deferred inflows and outflows. And of course, you're always welcome to call the office and ask Danielle Plossmeyer or myself those questions, because we can answer those for you. But generally, those answers are in your evaluation. And then from a financial reporting standpoint, for GASB purposes, you can go ahead. Can you go to the next slide, Jeff? The next two is just, it's our normal schedule of when we're going to issue those GASB reports. Because the GASB reporting is based on June 30th, that is part of our fiscal year-end processes. And we have to get through our financial audit before we can wrap up those GASB reports. The majority of those documents are not going to be available until October, early November. But anything that is contribution related, GASB requires those be determined by your fiscal period. So those are generally available the beginning of the second month after your fiscal year end. So if you're a June 30th fiscal year end, you're going to report your June wages to us in July, when we do our our monthly sort of cutoff process at the end of July, that's going to generate your scheduled contribution. So it'll be available then the 1st of August is kind of how those contribution related reports are generated for you. Okay, I think that's the end of my portion of the presentation. There we go.
Okay, all right, I'll finish up with just a few updates for you. Number one, legislative update. I'm sure some of you are already aware that we had a legislative change this past year that became effective August 28th. And what this is it allows you as an employer to choose to cover your jailers, EMTs, and dispatchers as public safety employees within the system, rather than general employees. And what that means is that will give those folks an age 55 retirement, just like police officers and firefighters, rather than an age 60 retirement. So this is something we've been working on for about 10 years. A few years ago, we got an iteration of this passed that was okay, but it wasn't everything that we wanted, which is typically how it works in the legislative process. And it only opened this option up to employers in third-class counties. So we waited a couple of years till the environment changed a little bit, and we went back and tried to get it to open up to all employers in every county. We were able to get that done this year. And so now if you have employees in these groups at your employer, you can look into the process of changing them to public safety employees with an age 55 retirement. This is a process you have to go through as an employer. We're hearing a lot of misconceptions about this, that one of the rumors we've heard is that effective August 28th, all of these people automatically have age 55 retirement. That is not the case. It does cost more for your employer to provide this because you are allowing these people to retire 5 years earlier than they could yesterday. And so it can't be an automatic thing because you as an employer have to choose to take on that additional cost. Also, this is different than any other benefit enhancement. The process is similar from your point of view. From our point of view, it's very different internally in the fact that we are actually going to be creating a new department within your employer called the Public Safety Department. So it's not as simple as just flipping a switch and saying, okay, these people have age 55 retirement. We actually have to create a new department with a new contribution rate. And then all these people have to be transferred from the general department to the new Public Safety Department, meaning that it's possible that your general contribution rate also will be affected. So there is a bit of a process you have to go through to do this. If you're interested in more information, contact Jeff Pabst in our office, and we can get you started through this process. I can tell you, since August 28th, even before August 28th, as soon as the governor signed it in July, there's been a lot of interest in this program. And so we've kind of set up a queue with employers, and we're kind of doing them in batches rather than just inundating our actuary with all these requests. So if you do want to look into this, I would at least contact Jeff soon, and at least he can place you in the queue of how that's going to go. This upcoming legislative session, we do not plan to propose any legislation at all. The main thing that we are going to be working on is defending the system against investment mandates. And this is something we've been swatting these flies for years now. And it's an issue that just keeps coming up. But basically what this means is you have special interests that believe that we should be investing your assets one way or the other. And in our view, the best way we can serve our membership is to let our professionals be fiduciaries and invest the funds in your best interest rather than someone else's best interest. And so it's something we've been defending against for a long time. The bills just keep coming up. We don't expect that to change. That will be something that we'll be definitely dealing with again this upcoming session. Okay, so some of you may be working on your Certified Loggers Administrator designation. Today's meeting is a core requirement for that. The Certified Loggers Administrator is something we started a few years ago. Basically, it's a way for you to learn more about the logger system and to help your employees learn more. If you're more educated about the logger system, I think then that will help you communicate the value of this benefit to your employees. You know, at Loggers, we're a very small staff. We have 38 people that administers benefits for all across the state. And so we really need people like you and your HR folks that have a good understanding of how the benefits work so that you can help us educate your employees. As much as we'd like to be everywhere all the time, we just can't do that with the staff size that we have. And so that's one of the reasons we developed this program is to provide you with better education, so then that could filter down to your employee groups as well. If you don't know what the Certified Loggers Administrator program is and you want to learn more, contact Penny in our office. Just call our main line and ask for Penny, and she can get you signed up to be enrolled in this program. So with that, that is all we had. Let me check to see if there's any more questions. We did get a few questions today. We really appreciate that. We appreciate you all taking time out of your day to learn more about some of the things we do here at Loggers. And I'm not seeing any other questions. So with that, I think we'll sign off. Melissa, do you have anything else you'd like to add?
No, other than, like I said, if it's GASB, if it's your actuarial evaluation, any question you guys have, please don't hesitate to call the office, because that is what we're here for, and we can get you the answers. So
that's right.
And to wish everybody a Merry Christmas.
Yeah, Merry Christmas, Happy New Year. And as Melissa said, please call if you ever need anything from us. We are here to serve you. Thank you very much.
All right, thank you.